right, to help us through the pre-holiday trading day, Dan Haugh joins us. He's the president and co-founder of PTI Securities. He's at the CME Group in Chicago. And also in the Windy City, we have Charles Bobrinskoy, vice chairman and director of research at Ariel Investments. He manages the Ariel Focus Fund, which has returned almost 10% this year. And Charlie, let me start with you. You're bullish on stock, bearish on bonds. You have been for a while, so you got that call right. But does it continue in this direction? I mean, do we see yields continuing their rally up with stocks? Or not
yes,
rally, continue their ride up as bonds come down and the rally with stocks.
Absolutely. When people open up their statements and see what they thought were their safe bond funds, particularly their municipal bond funds, and they see the hits they've taken, we're going to have a reversal from the flows into bond funds, and they're going to take that money, it's going to move into equity funds. We've had basically no flows into equity mutual funds this year. That process is going to reverse next year.
Now, if it does reverse substantially, that could be a huge windfall for the markets. I mean, how much higher do you see stocks going?
You know, I think we will have something like low teens returns. I don't want to be too precise, but I think we would say better than 10% returns next year.
Dan, this is Emily here. Not just how much higher, but how much longer can stocks keep going as they have been?
Well, I'll tell you, it certainly does seem like the stock should have a little bit of a rest here. I mean, ever since they first announced the QE2, we've had a substantial run up. The Russell's up 30% in about 10 weeks. That's a major move. So you got to assume that we're going to have a little bit of a breather here. But, realistically, there's nothing that says that the next quarter earnings are going to be, anything but good. So, you got to assume that once the money starts coming out of bonds, as he mentioned, and we get good earnings, that we're probably going to continue up after January.
Looking at this thin trading, Dan, let me just ask you quickly a question I wanted to ask yesterday, but how difficult, how dangerous does it feel to trade on such a day of such thin volume?
Well, it is kind of misleading, but I mean, realistically, if there was a change in trend, I would kind of be a little bit uncomfortable with it, but it hasn't been a change in trend. I mean, every day, no matter where we open, we seem to trend up during the course of the day and close close to our high. So, yes, it's getting less and less volume, and probably will continue that to the end of the year, but I mean, it's not a change. So the only place we saw really good volume here today was in the bonds when there was suspected government buying. But other than that, I mean, it's the trend. So, I mean, I don't see any reason to disregard it.
Let me also ask you about, we've had a lot of positives with QE2 and the tax cut compromise. Do you expect that it's all priced in, though, now, Dan?
I would have thought QE2 was priced in long before it stopped being priced in. So maybe this has a little bit further to go with the tax cut. But every time we get a bad week or a bad month, like the first week in December, last week in November and all of August, the government seems to be pulling a rabbit out of the hat. I think those days are gone. So starting next year, I mean, we're going to have to do this on earnings.
Charles, I want to send this one out to you. We're hearing a lot of good news today, but how vulnerable is the economy still really with all of the negative indicators out there, like unemployment, like Europe, and those looming downgrades?
What we're hearing from our managers is that they're actually more confident now. People forget that big companies generate more than half their profits from outside the U.S. I think for Johnson & Johnson, that number's like 60%. IBM is about 55%. So, yes, we have high unemployment, but managers are saying the trends are pretty good. We've got a lot of pent-up demand in lots of areas, including auto, retail, even some signs of life in commercial real estate. So, in general, we think things are getting better, not worse.
All right, thanks so much, Charles. Now to Julie, you've got more on the S&P recovering to levels from before Lehman's collapse. Let's break it down into sectors. Which groups were winners, which were losers? Julie?
Right. Well, we're calling it the comeback that we've seen from these levels that we've been talking about really all day today. And what we've seen here is that, right around September 2008 is when this big drop happened, of course, as Lehman Brothers collapsed. Remember, we still kept going down for another 6 months or so until March of the following year. And then we have seen this rally back. Remember, the number that we were looking to beat, 1251 or so, 1251.70 to be exact. But if you go back on this chart, if you went back in time, you would see 1565, remember, as the all-time high on the S&P 500, and we still haven't taken that out. Now, how have stocks done since September of 2008? Financials are still in the red, people, down 25%. Utilities and energy, healthcare and industrials are all still down, but really the bulk of it still has been in the financials. That's the group that has still done the worst. Even though it's done the best since the bottom in stocks, it's still down from the pre-Lehman days. In terms of stocks that have done the best, what has led us out of this? It's been consumer discretionary, up 22%, and technology. So really a lot of that has to do with the consumer. It also has to do with businesses coming back and increasing their spending as well. And if you're curious about individual stocks, AIG is the worst performer since the day before, the trading day before, that is. Lehman Brothers collapsed, down 77%. The other one's also a financial, Citigroup, down by 74%. So even though we've come a long way, especially when you're talking about the financials, there's still a long way to go. And I actually want to toss this out to Charlie. You know, with the optimism, relative optimism that you have about stocks, 1565, the all-time high in the S&P, you think we can take that out in the coming year?
Yeah, always dangerous to look backwards. Always much better to look forward. I wouldn't go to 1,500, no. I mean, we're using a number a little less than 100 for the earnings of the S&P 500, probably about 95, up from $84 for the S&P earnings in 2010. So with something less than 100, I'd be pointing more towards mid-1300s for where we hope it'll get.
Hey, Charlie, I want to get your take again on the bond market. We talked earlier to Gregory Peters. He's the global head of fixed income over at Morgan Stanley. Here's what he had to say about bonds.
If the Fed is successful in QE too, then growth is higher, inflation higher, which ultimately means that your bond investment will be less. So it's a tightrope for sure. I mean, we do think yields move higher, not dramatically so, but that is a real question in 2011 for sure.
All right, so Charlie, it could be good news for the economy, not necessarily great news for bond investors, especially bond fund investors. But he doesn't think yields will move dramatically higher. How much further do you think we have to go? Is 5% on the 10-year a possibility by the end of 2011?
No, I mean that would be pretty catastrophic. I mean, to go from 330 that we are now to 5, it's not impossible, but I wouldn't be that pessimistic. But you have to remember, if the 10-year bond goes up by only 11 basis points, you lose about 1% of your value. So if interest rates go up by 100 basis points, you lose about 9% of your value. So it doesn't take big moves in interest rates to produce big losses.
Hey, Dan, it's Dominic here. I want to bring you into the discussion here. We've seen this kind of go a long way really quickly here, especially with bond yields and with stocks. Is there any kind of reprieve anytime soon? Doesn't the market need to catch its breath at some point here, right, Dan?
Well, I'll tell you, especially with the, the major indexes, they've had a major move since the end of August. I mean, the Russell's up 30% in 10 and a half weeks. I mean, if you were to make a bet that every time the market has made that kind of move, you pile on and buy, that probably wouldn't be a good bet long term. I mean, every time you did it. So, yeah, I think there should be a rest here. But, I mean, in keeping with the bonds here, I mean, there will be some upflow in the bonds. I mean, look at the pain people had in November. I mean, the 10-year yield went from 2.3 to 3.4. A lot of bond portfolios lost 4 or 5%. That money is going to go somewhere, so that could potentially go into the stocks.
All right, thanks so much,
Dan. Just to quickly interrupt, to just say that although smaller cap and lower quality stocks have run 30%, higher quality stocks haven't run near that much. So we would look for the higher quality part of the market to outperform going forward.
All right, thanks so much, guys.